I know you're always extremely thoughtful about the markets. I don't know what it feels like from where you're sitting today. Are you worried about the future, or are there glimmers of hope?
Well, there's always glimmers of hope. We're never completely without hope, but it's a pretty tough environment. I think when you look at where we've come from and the extent of the correction that you've come from, you definitely in equity markets have seen a fairly substantial derating, and probably that's pretty much run its course. And now it's all about what the earnings patterns are from here, and obviously what the central banks managed to do in terms of bringing inflation under control.
So are you expecting a lot more of a correction when it comes to some of the earnings? I mean, it's all about margins, and extremely difficult for certain, parts of industries to pass on higher consumer inflation.
The risk of a recession has unquestionably gone up. I'm not certain yet that all parts of the world are going to go into recession. Markets are discounting mechanisms, so they've discounted part of that. But clearly, if the backdrop of the economic environment accelerates in a downward direction, I think you could see more volatility in markets. So I don't think we're through this period yet, but I think there is some hope that possibly we could be seeing the sort of peak of the bearishness, but we're not quite through it yet.
So what happens in the next couple of quarters, and how difficult is that to predict for an asset manager? Does it change the way you work?
Look, it's terribly difficult to predict. And that's, I think, as you know, this kind of environment, which is like a turning point in sentiment, a turning point in the sort of economic backdrop, really, really difficult. And of course, we're coming into this from a very unusual cycle, right? So we've had a compressed, deep recession followed by the most extraordinary bounce back. And then on top of that, you've had these external supply shocks, first of all, on the oil price side. And then, of course, with the second wave, big wave of COVID in China, with the sort of contraction of economic activity there and the sort of stumbling blocks that have been put in on the supply chain, that has been sort of a double external shock, which has once again put this huge amount of grit into the economic machinery. That being said, I think you're starting to see the Shanghai situation in particular improve, which I think is a big tick. And where we get to on the oil price, the gas price, I think is the next big thing that you sort of hang on. But so what do you do when you face into this? I think diversification is extremely important in that. We think probably that in terms of bond markets, it'll be credit spreads that take the strain rather than the bond market itself, if you like, Treasury. So we think, government bonds probably feel less volatile from here rather than credit. But it is still quite a challenging environment. And I think we've probably got another 2 quarters at least of volatility as we see the sort of economic backdrop gradually ease a little bit. And then we'll be looking towards the fourth quarter maybe to see a little more clarity coming
through. Do your clients want exposure to China?
Interesting. So we're still seeing quite positive sentiment on China, notwithstanding the sort of more difficult backdrop that we've seen. It's such an important and major part of the world economy, and probably is the part of the world where you'll see economic activity resume more quickly. So we're definitely still seeing quite a lot of positive sentiment towards China, particularly given the correction that you've seen in quite a lot of the market there.
We caught up at a dinner yesterday, and you said, I want to come on and talk about the F word. And the table stopped in their track, and it's like, and food. How should we look at food and food inflation, food security? Is this, the biggest challenge of our times?
Yeah, so one of the things that has been just both, I think, really constructive about the conversations this week is how the risk of a food crisis has gone right up the agenda, and you've seen a tremendous amount of leaning in from all sorts of parts of both the political and, if you like, the corporate infrastructure to figure out how can we avert a major food crisis. Some good news overnight about maybe beginning to find a way where we might get some of the grain out of Ukraine, and that is a really, really important step in all of this. We're not there yet, but I think it's been one of those examples where actually getting people physically together, talking constructively. Of course, President Zelensky challenged everybody on Monday, like, you've got to get on top of this, people. And I think you've definitely seen some of those conversations progress. So we're not out of the woods yet on that, but I think we have made real progress this week in actually figuring out what it is we need to do to make sure that food and the food chain does not get weaponized in times of war. And if we've managed to achieve that this week, I think that will be a tremendous, tremendous result.
But is there enough global cooperation on this front? It feels like, half the time we talk about deglobalization as each region and country is looking after its own interest.
I'm not as much of a believer in the deglobalization story as some people are, because the globalization versus localization is a false comparator. There are many advantages to having properly global supply chains. But you have points of weakness if you allow too much concentration on one supplier or one location. And that's true for localization just as much as it is for globalization. And what we've seen in the structure of food around the world has been a concentration that we really weren't aware of. Who knew that an invasion of Ukraine and the disruption of that part of the food chain could have such consequences in continents very far away? And that's exactly what we've seen. So it's a reminder of the connectivity of us all. So you can't deglobalize a globe. It's really not that simple. What we need to understand is how we can deconcentrate, if that's a word, but remove some of that intensity of concentration so that we make the system as a whole more resilient. And that's not globalization versus localization. That's really being thoughtful about what is your plan B, what are the options, how you build that optionality into systems so that you have more resilient systems when there is an unexpected shock.
And when you look at inflation, so this is one of the main concerns which we talked about a little bit at the beginning about how you build a portfolio around that. And then you have climate change. And of course, this huge transition. Will it automatically be inflationary?
I don't believe that, because I think there may be an inflationary aspect to it right at the start. But what we've seen with, for example, renewable technology, whether it's solar or wind power, we've gone down the cost curve so fast, much faster than has ever been anticipated, as demand picked up and as technology innovated and improved, that I don't see why it should be any different as we continue to evolve. So yes, you've got that sort of first big lump of investment that has to go in as the new technologies evolve. But driving down that cost curve is something that you've seen in every technological revolution for 200 years. Once you get onto that sweet spot, it moves really, really quickly. So arguably, the kind of crunch point that we've seen ourselves in over the last 6 to 9 months will actually spur more of that and get us through that hump a little bit more quickly. There is a trade-off, but I think that with care, we can probably navigate through that. We might eventually be positively surprised.
As chief executive, I imagine you spend a lot of your time thinking about talent, about recruiting, about your people. Do you have, you have flexible, working days. Will that stay forever?
Well, okay, nobody can say anything is forever, right? But one of the things that was crystal clear to me when we went into the first phase of the pandemic just over 2 years ago, and we had to flip the entire business. We had more than 99% of people working from home, from their bedrooms, from their kitchen tables, sometimes lucky people with lovely weather from their gardens. That was very nice. That wasn't me, sadly. And we trusted them to do it, and they did it utterly brilliantly. So I don't see why we have to say to people, you have to be back in the office for X or Y or Z days. I think we can build something which accepts we do need people to come together. Culture is important. You build that. I mean, we've seen that this week, how wonderful it's been for people physically to be together in 3D, not just in 2D. So, I think it is important to that we come together some of the time. But we certainly don't need that to be 5 days a week. And we don't necessarily need that pattern to be the same for every person because of the type of work that their team does, whether it's project-based, program-based, whether it's physically based, whether it's working collaboratively on research and fund management. So what we've tried to do is say to people, okay, you need to establish what is the right pattern for your team. Here are a few templates. You can do 1 day a week, 1 week a month, 4 days a week. And then there's a kind of a la carte. You figure something out which works for you. Trial it for 3 months. If it works, keep going with it. If it doesn't work, iterate, try it again. But we're trying to give that agency and that flexibility back to people.
And you're full-time back in the office?
I'm 4 days a week in the office. I try and don't always do Fridays from home, but I try and do Fridays from home just to tell people it's okay not to do 5 days a week in the office. Sometimes it is 5 days, but that works for me. I like being in the office, and I'm weird. I like being in the office on Mondays, by the way, because it's really quiet. So that suits me.
Less traffic. I agree.